Hi everyone, and welcome back to the Independent Dollar as we make our way through the end of our January retirement and savings series. If you're joining us for the first time, we make new videos each week on personal finance topics in a way that's straightforward and easy to understand. Today's topic is all about RSPs as we explore some examples of when you should, and in some cases, shouldn't be using them. Now that the holidays have come to an end and we make our way through the start of the new year, we start to debate what the best course of action is for our investments. For those of us that have been saving for retirement for a while now, the RSP has probably become a staple of our retirement. Introduced in the late 50s, the government created the RSP as a way to encourage Canadians to save money. Over the years, the rules have changed for higher investment limits, carry forward of unused room, and removed many of the restrictions on what we can and cannot invest in. According to the 2016 census, almost half of Canadians hold either an RSP or a registered pension plan. The major benefit of the RSP, though, comes in twofold: deferral of taxes until retirement and forced savings that has a set purpose and goal. But is an RSP for everyone? Today we're going to look at a few different scenarios: a young adult starting off in the workforce, an individual growing in their career, and finally someone in their highest earning years before retirement. For a young individual just starting off in the workforce, their career salary and total income will be on the lower end of their career earnings. According to a Stats Canada report, the median income for someone between the age of 16 and 24 was $11,600, likely a result of part-time work while pursuing education aspirations. The total taxes paid for an individual living in Ontario would be as follows: federal tax $0, provincial $0, and CPP and EI premiums $590. Any taxes owing are through CPP and EI contributions, which would not be reduced through an RSP contribution. On top of that, with non-refundable credits such as the working income tax benefit, this individual would actually be receiving a refund of over $1,000. Therefore, a deposit into an RSP would likely result in taxes payable in retirement on income that would have otherwise been tax-free. In this case, an RSP would not be advisable, and earned RSP contribution room should be left to accumulate for higher earning years. For those between the age of 25 and 34, the median income is much higher at $38,400. It's likely at this stage, while income has increased, so has debt levels, tuition, car loan payments, and maybe even a mortgage. The same individual living in Ontario would now see their taxes rise to about $5,200, and about $2,300 on top of that towards CPP and EI. Their marginal tax rate is now sitting at about 20%, which may or may not be lower in retirement. An RSP contribution would help lower their taxes today, but unless that refund amount is reinvested, the benefits are lost. So what is the ideal choice then for this group? The TFSA limit for this year is $6,000. They could consider maxing out their TFSA instead to still reap the benefits of tax-deferred growth, and any withdrawal in the future would be tax-free, which means no impact on income-tested benefits as well. If there is a substantial increase in their income in later years, they could then consider using an RSP to reduce their taxes owing. Your career is now starting to take off, and for some, that might mean a higher level of compensation, or a mix of salary, commission, and benefits. If you're fortunate enough to have a workplace pension, what you now need to consider is the amount of income you can expect to receive from your pension in retirement, as well as CPP and OAS, and compare that to the amount you'll be forced to withdraw from your RRSPs. Does this tax deferral work in your favor or against? If your company offers an RSP matching program, this may be a reason to prioritize RSPs, at least up to the matching amount, as it's a guaranteed 100% return. For those of us who struggle to hold on to savings, the increased difficulty in accessing RSPs might be the perfect first and last line of defense against liquidating our retirement nest egg. However, at higher income levels, your CPP in retirement could be close to the maximum, and if you're saving near the top end of your RSP limits, your income in retirement could very well be higher than what it is while you're working. If you suspect your income in retirement to be lower than what you earn now, then a mix of an RSP and a TFSA will allow you the benefit of reducing your income taxes now while still allowing you a buffer that you can draw from, tax-free, in both the short and long term. If your income will be around the same or higher, RSPs are probably not for you unless you've already maxed out your tax-free savings account or your company offers an RSP matching program. As we approach the end of our careers, the challenges we are looking at are very similar to our mid-career stage. At this time, a clearer picture emerges of our income needs and expectations. Individuals that continue working through retirement age will face a double-edged sword. They have their primary income from employment but will be taxed at a higher rate on their RSPs and RIF withdrawals. OAS and other income-tested programs might also be reduced if your income is higher than expected. If working in retirement is a likely reality for you, cutting back on RSP contributions in your 50s and 60s might be advisable. However, if you expect to work well past 65 and your income will be higher in retirement, then RSPs may not be the right fit for you. At this point, if you haven't sat down with a financial professional to discuss your retirement plans, we would recommend doing so. And this can be done either with an individual who would invest your assets for you, or alternatively with an individual who provides only advice and planning for a flat fee. And the latter might be your preferred method if you already have a grasp on your own investments. This wraps up another video in our retirement and savings series. Feel free to comment below if you have any questions or to just let us know what you thought of the video. Thanks so much for watching, and we'll see you back here on Thursday.